So when we look at annuities, a lot of advisors will ask us, how much should I allocate? Or what should I use an annuity to fund? How do you think about that?
When it comes to how do I allocate to an annuity, the starting point I like to use is just, what does it take to fill an income gap? That you have these expenses that the client really doesn't want to be exposed to stock market volatility to be able to fund those expenses. And then you offset, well, if they have a Social Security benefit, if they have a traditional company pension. After that, is there still a gap in what they would like to be able to reliably spend? And then how much annuity would it take to fill that gap? Is that a reasonable portion of their assets? That would be the starting point. Now, I do often hear that question expressed differently, which is more of an asset allocation question. Mm-hmm. How much stock should I have? How much bonds should I have? How much annuity should I have? And I think you can think about it that way if you're looking to just, well, I don't know how much I want to spend, but I want to get a sense of what is a reasonable spending level. And then thinking about 20 to 40% into the annuity can really help lead to a more secure retirement foundation. And especially to the extent that you can draw those funds from the bond side rather than from the stock side, not only can that help better protect income, but once you get past life expectancy, really improve the odds of leaving a larger legacy at the end as well. That annuities, when it's not too high a percentage of the overall asset base, can lead to larger legacies. The idea of you're not necessarily giving up the upside with the overall strategy.
So a lot of advisors don't, think about it that way. But what it means is that you can generate, $1 of income in retirement cheaper using an annuity than you can with a traditional fixed income portfolio, which for us, one of the questions is also the client. Which client should be using an annuity? Who should I use it for? And we typically are answering with wherever you're going to take income out of the portfolio. You should be looking at an annuity. And the flip side of that, what you were just alluding to, because you can fund income more efficiently, it gives you more to invest however you choose to as an advisor. If you want to invest more in equities during the rest of the client's lifetime, can lead to a bigger legacy.
Right. The technical term is risk capacity. How exposed is your lifestyle to stock market volatility? And when you have an annuity, your lifestyle is less exposed to stock market volatility, and that gives you more risk capacity. That means if you want to, you can invest the rest more aggressively. And that, of course, if markets do fine, leads to the potential for more growth while also protecting income through the annuity as well.